Executive Officer of Debenture. We are a FTSE 250 listed investment trust and owner of a professional services business with over 300 people in 8 offices around the world. And welcome to WIN, our Widening Investor Network event. We did our first one exactly a year ago, and this is the third one we've done. The point of it, what's WIN about? We heard through our professional networks, we deal with a lot of accountants and lawyers and actuaries and people like that. And what the feedback we got from them is very much people at the start of their investing journeys don't have access to, if you like, a safe space where they can ask any questions. And so tonight, anything goes in terms of a question, right? This should be simple stuff. And if you're feeling like you're not following along and the panel are talking in jargon, you can put up your hand and say, I have no idea what you're talking about. Because the success of this evening is about the panel effectively communicating to you the different aspects of how to start out on an investing journey. So that's the purpose of it. Thank you very much to City AM for helping us in particular and Rupert for moderating tonight's event. I'll allow him to introduce the panel just in 2 minutes. Housekeeping notices, it's the usual stuff about fires and not expecting them. If we do have them, then people should appear with nice fluorescent jackets, follow them out the building. If they don't, just follow me because I know exactly where all the shortcuts are and I will be out of here with haste. And I think the point to make is just in terms of we will take questions at the end of each panel. If you want, for those of people, and there are people outside of the room, so do type in your questions. We will get access to those questions during the course of the evening. For those of you in the room, please stay with us for some drinks afterwards. And I think I would just say, because it is being streamed, please just be aware, mindful of noise within the audience, because that's obviously difficult for people who are outside of the room. So I think that's all my housekeeping notes over. So with that, I'll hand over to Rupert. Thank you.
All right. Thank you, Dennis. Hi, everyone. I'm Rupert Hargreaves, the Managing Editor of City AM. Thank you for Debenture for hosting us here tonight. So we're going to kick off with our first panel on why UK investing is worth it and what to look out for in the current market, something people might be questioning, considering what's going on in the news at the moment. But I've got with me up here on the stage tonight, we've got Laura, the Debenture Portfolio Manager, Kyle at the end from Interactive Investor, and Nina from St James's Place, the Senior Investment Specialist. Laura, I just want to start with you. Can you give us a bit of insight from your side on the UK investment prospects and what you think about the country considering the stream of news flow?
Thanks for that, Rupert. You really sort of set me up for success there. Good evening, everyone, to start with. I think the key thing to remember about UK equities is that UK shares and the UK economy are not one and the same thing. So on average, UK equities make UK shares, jargon buzzer, make roughly 3/4 of their earnings from overseas. And as a rough rule of thumb, the larger the company gets, the more international it will be. So if you look at the biggest companies in the UK, I think AstraZeneca, HSBC, BP and the like, these are not exposed in any meaningful way to the UK economy. So I'm sure everyone in the room will read the paper. They might have a view about whatever it is, the budget or where interest rates are going. But actually, for the biggest companies in the UK, those things aren't particularly meaningful. What is meaningful is that UK shares, again, on average, trade at a discount to the rest of the world, and a pretty meaningful one. So let me put some numbers on it. And remember, it's not share prices that matter. It's share prices relative to things like earnings, company sales. A share price alone doesn't give you any useful information. So UK equities/shares are cheap on a measure that we call price to earnings, PE. So if you ever hear PE, this is a valuation metric that people use. And what it shows is for every pound of earnings, how much do you have to pay in terms of a share price? So if a company makes, say, £1 of earnings and the share price is £10, the PE, price to earnings, is 10 times. Now, in the UK, for the whole market, you have to pay about 13.5 times. If you're looking at the States, it's over 20. So for every pound of earnings, you are paying considerably more for a US company than you are for a UK one. And a lot of the time, they're international companies anyway. So you would often pay for quite an equivalent company, say a BP, a Shell, compared to, say, an Exxon, considerably more for that overseas company. And you would question the logic of that when they aren't actually very exposed to the UK economy. And the result of this, what we're seeing, is that UK companies are often being taken over for this reason. And you're seeing some quite considerable prices paid above the current market price for exactly that reason. So I am positive on UK shares, but that doesn't necessarily mean I have a view on the UK economy. I think, you could ask me what I think the economy is going to do next quarter, and I wouldn't actually have a strong view. Someone else, an economist might have a stronger view on where interest rates are going and things. I do have a view on UK shares. So I think that's the key thing to bear in mind. UK economy does not equal UK shares.
Okay, and then for Nina, when you're looking at a diversified portfolio, what role should UK equities play in a globally diversified portfolio?
Yeah, so I would argue that, and good evening everyone, I would argue that the UK holdings in your portfolio should be both a core and at this present time a strategic holding. Now, Laura took all the words out of my mouth. We think exactly the same on all the fronts that she spoke about. And if you have a global starting point, so you are able to invest in global companies, so you're not restricted to just the UK, I would argue that a core holding, because you are in the UK, makes sense, because that's where you live, that's where you want to derive an income from at some stage, and strategically because of what Laura was saying about valuations, so how cheap or expensive the market is at the moment. Again, we think the UK is pretty cheap at this point in time, especially relative to the US. And another key factor is that the UK market is a lot less concentrated than other global markets. So, for instance, in the US, and everyone's been very bullish on the US, obviously, in the last 10, 12 years, it has become a very concentrated market. So if you're investing broadly in that market, you're getting exposure to mostly technology shares, which we've seen have done so well. And that has led also these valuations to go up. So I think the converse of that in the UK is that you're not getting this concentration. And in times of uncertainty, it is those very concentrated areas of the market that are that become vulnerable to any bad news. So the high price, the very expensive areas of the market and the very concentrated areas of the market are a bit vulnerable, I would say. Which is why, again, the UK equities we have a very positive view on them at the moment.
So moving on to you, Carl, when you're building a UK equity portfolio or trying to incorporate UK equities into a global portfolio, what tools, funds, investment trusts, ETFs would you be looking at?
Evening, everyone. So I think one of the dilemmas for a retail investor is that there's too much choice. There's thousands of funds, so it's very overwhelming, especially when you're at the very start of your investment journey. I mean, for the UK alone, for UK funds, there's about 400 of them. And for investment trusts, I gather a guess about 40 or 50 overall. So how do you cut down that amount of choice to have like a short list of options? So for me, one of the main things to consider is, do you want to own the market? Do you want to own it cheaply through an index fund or an ETF and broadly gain the exposure, gain the returns of that particular index? And there are index funds and ETFs that will track the up and down movements of the FTSE 100 or the FTSE All Share. Or do you want to entrust the fund manager to potentially beat the wider market? Some of them do over the long term. However, that's not the case for all fund managers. And in terms of an actively managed fund, and an actively managed fund is a fund that's managed by a professional investor like Laura. Among the things to consider is the investment objective. So is the fund aiming to deliver, is it mainly focusing on capital growth? Is it mainly trying to focus on high income opportunities, or is it aiming to deliver a mixture of the two? And you need to think about your own objectives and what you want to achieve. In terms of the UK market, it's got a rich dividend heritage. It's one of the highest yielding markets in the world. The UK market yield is around 4%. However, I do think there's a bit of a misconception that investing for income is for someone later on in their investment journey. It can be a really powerful tool for younger investors at the start of their careers, because with investing in income stocks, if you reinvest those dividends over time, then the compounds and returns that you gain from those reinvested dividends, they snowball over time. So investing compounding is when investment returns themselves generate future gains for you. And with reinvested dividends, that just makes that phenomenon even more powerful for me. And in terms of active funds as well, what I like to consider is, how is this fund or investment trust investing differently from the wider market? Because ultimately, to beat the wider market, a fund manager has to invest very differently from it. This is a bit of a crude measure, but one thing I look at is how a fund or investment trust has performed versus an index over, say, 1, 3, 5, and 10 years. And if you plot it on like a line chart and it's pretty similar, then that to me is an indication that the fund manager is probably not taking enough active bets away from the index.
I just want to pick up something you mentioned there. You were talking about the FTSE 100. Everyone picks on the FTSE 100. It's the biggest index, the most widely cited index in the UK. But in terms of actual UK companies and UK businesses, it doesn't contain many UK-specific businesses. Maybe that's something you would like to pick up on, Laura, a little bit.
Yes, exactly. You're completely right. So going back to that rule of thumb, the FTSE 100 is roughly 3/4 overseas. Once you go down to medium-sized companies, so the FTSE 250 index is the next 250 companies down, it's more like 50-50. So it's 50% domestic, 50% overseas. And then when you get down to the small cap index, it's the reverse of the 100. So it's 3/4 domestic and the remainder overseas. And the reason for that is completely logical. It's smaller companies start in their home market and then go overseas. So as they get bigger, they get more international. And obviously there will be exceptions, but that's just the general rule.
And UK small caps have actually had quite a good performance over the past, say, 5 and 10 years. If you know where to look.
You would be right on a very longer term view, but they've had so the FTSE 250 and FTSE small cap plus AIM, in particular AIM, have had a tough time in recent years for all of the reasons that you effectively covered in your intro, that people are more sceptical about the domestic economy, and that's been particularly since Brexit, and that's been felt in the valuation of those companies. Now, I'm going to reverse what I said at the beginning, that if you actually think the UK economy is okay and not doing as badly as you might read in the press, and that there are perfectly good and well-run, well-managed domestic companies, that is the lowest valued area of the market. So if you were a person that thinks, actually, maybe it's not quite as bad as I read in some of the papers, then to get exposure to that, you would need to look beneath the FTSE 100.
So maybe I need to just revise what I said a bit there. I've been looking at investment trusts recently, and smaller company-focused investment trusts, and some of them have delivered fantastic returns.
Yeah, you're right, and that's through their good stock picking. There are always companies that will beat the market and will do incredibly well, and there's some good stock pickers out there. But on average, as I said, particularly AIM has had a tough time.
So, talking about specific names here, I'd like to pick up on some of the specific names that Lauder has really picked very well over the past few years, one of which is Marks and Spencer's. Could you just talk a little bit about how you came across that opportunity and how you ran it and how are you looking at it today?
Yeah, funny enough, I've spent quite a lot of time thinking about M&S today. We bought it in 2020, so in literally March 2020, so anyone that remembers that time will know that I think they'd have had to close most of their non-food stores. It wasn't the best, didn't feel like the easiest time to be buying a retailer. But Archie Norman, who is their new chairman, who's had a very long retail background of successful turnarounds, had come in, and this might sound strange, but what made us buy the shares is he wrote the most brutal annual report about M&S, saying basically, if we don't change this, this company's not going to exist. And we've got to finally get ourselves into the 21st century and do the things that, as a customer, to be honest, a lot of the time were common sense. So this Archie said things like they had 30 pairs of men's black suit trousers. So you'd go into a shop and just be completely flummoxed as a consumer. And by the way, and they still haven't fixed this, you'd go in and they'd have one size and it's not the size you want. It's just really basic things that you need to get right. But the funny thing about M&S is that actually their market share in clothing, for all the fact that everyone thought it was kind of rubbish, the market share had remained really high. People almost wanted to support that brand. It's seen as a real sort of British brand. So all they needed to do was tweak these things, get the clothing, get some clothing that women want to wear. And actually it fixed itself relatively quick and quicker than we thought, quicker than we expected. And the shares, they got through COVID and the balance sheet got a lot better. Stuart, the new chief exec, is running it very well. And it's now got to a point where the earnings are different, the value on the shares is different, and we've been gently going the other way and taking profits in that name.
And what about another player like Rolls-Royce or the banks, for example?
Obviously, very, very different end markets, but actually, in the case of Rolls, quite a similar story in that you get a new chief exec who comes in and says, I think the words were, this is a burning platform. Actually, quite similar message to what Archie Norman was trying to say at M&S. And similar in that they had a lot of sales. So in this case, the way Rolls make money is when we fly, they do the engines, but they really make money on the engine maintenance. So you need people to be flying around the world. Again, difficult during COVID for obvious reasons, but as soon as everyone went and had a holiday again, they make some money. But you needed a new chief exec to say that we're going to take a lot of costs out. We're going to really try and hold our customers to their contracts and make proper money on these contracts. And again, it's about making more money for a similar amount of sales. So it's not a similar story where the earnings have moved substantially higher, the valuations move substantially higher. And again, we're actually going this way and reducing that holding now.
So I think we want to clarify that people shouldn't be going out and buying their individual shares. Statistically, you're probably likely to underperform doing that. So Nina, could you just explain how an investor should approach, if they want to invest in the UK or they have a favourite name they want to be buying, how they should build a portfolio around that?
So from my perspective, I'm more on the investment side of things, so maybe Carl can pick this one up, but I would advocate finding a fund manager. So we do a lot of due diligence into the managers that we invest with. And due diligence, it's a huge amount of rigorous research that goes into finding the best managers out there or the best funds that are available, because they're thousands, right? But so I would find someone who's able to research managers properly. And then when it comes to funds, maybe Carl, if you want to pick up.
Yeah, I should have said really earlier that obviously if you invest in a fund, so you're getting the stock picking expertise and you're getting lots of diversification, because it varies, but a UK fund manager, they're going to hold typically 40 to 70 shares. That's just a rough guide. And you're getting exposure to lots of different sectors and industries, getting exposure to lots of different company sizes. So some funds, investment trusts will invest across the market in large companies, medium-sized companies, which are in the FTSE 250, smaller sized companies, which are in the FTSE All Share, and also AIM as well, the AIM market, the junior market. In terms of building an exposure to the UK, what I wouldn't think about is that the UK only forms like 3.4% of the MSCI World Index. For a UK investor, you're not going to want 3.4%. That's, it's your home market. Most investors have a natural sort of home bias to their home market, and it's hard to say what the exact amount should be in the UK. But for me, it should certainly be higher than 3.4%.
And what are you seeing for your clients on Interactive Investor? What are the trends there that people are actually buying?
We've seen for a number of years now, customers are focusing on going global. So we produced this report, a quarterly report, where we rank the most bought funds, investment trusts and ETFs over a 3-month period. The last one that we published, which was July, so that was for the second quarter this year, 17 of those 50 funds were global. Most of those global funds were index funds or ETFs. For me, that's a reflection that, you know, the global stock market, it's served investors very well over the past 10, 15 years. If you have just gained exposure to the market, you've done very well. Whether that's going to continue in the next 10 years, you know, I'm not Mystic Meg, unfortunately. But what I would say is that the global stock market, and particularly the US stock market, it's become very concentrated. So in the case of the US stock market, 7 companies, the so-called Magnificent Seven, account for around a third of the S&P 500 index. If those companies, they perform very well over the long term, but if they, you know, in 10 years' time, are they going to be still the 7 biggest companies in the world? History tells you that over time, things change and companies struggle to maintain their dominance over time. In terms of UK exposure, of those 50 funds, only 3 are funds that invest in UK shares. One of them is City of London Investment Trust. And then there's 2 index funds, one from iShares and one from Vanguard. Why are people not why are retail investors not warming to the UK? I think it goes back to the point that Laura mentioned at the start, that I think there's this misconception that the UK economy and the UK stock market are one of the same thing, but that's not the case at all.
So moving a little bit wider then, probably taking a step back from the UK, and this was one for you, Nina. In terms of what you're seeing around the world, the sectors and the industries that you're most excited about globally, and you can talk about the UK as well.
Yeah. So I would say it's not tech. No, at the moment, where we see value is in more of the defensive areas of the market and defensive sectors such as consumer staples, industrials, healthcare. That's great for the UK because we have great exposure in those sectors at the moment. That's not to say that I think you shouldn't be invested in tech stocks at all. That's not the case. It's just it always goes back to valuations and where the value is right now, and diversifying. And from a portfolio construction perspective, how you build resilience in your portfolios and your investments is by having diversification and slight overweights in the areas that show value currently and underweights in areas that are very expensive. So, for instance, we have quite a heavy underweight in the US currently, and that's in favor of regions such as the UK, Europe, Japan at the moment. And then if you drill down even further, things like small caps, mid and small caps in the UK especially, the combination of something being very overlooked, under-researched, which means that the market is most likely not assigning the proper value to these companies, and also being very depressed in terms of valuations, that combination, that's a great starting point or a setup for excellent future returns. So that's always something I would keep in mind no matter what area of the market you're looking at.
You mentioned defensive sectors. What about defense, which seems to be the hottest sector in the world at the moment?
Yeah, I mean, I think, yes, it is. There's a lot of money flowing into defense at the moment. There is value there. Again, we've seen, in areas in Europe, like in Germany with the stimulus package, that money is flowing to defense. I don't think that's going to slow down anytime soon. And now we're also going into things like responsible investing and all of the rest of that. We don't have time for that. But I think there is value in certain parts of defense. And it still has room to run, I think. And
I'm going to come back to you now, Laura, just to ask you, for future, looking out over the next 5-10 years in the UK, what are you really excited about in terms of a fund manager, and what do you really want in the portfolio?
So it's a good question, and I'm not going to give you individual stocks. And the reason for that, so you're right to say that most fund managers have 40 to 70, is that what you said? For Lord Debenture, we have 150. And so we're not running a short list of high conviction stocks, and I will not pick a favourite child. But I think Nina is exactly right. Why we talk about valuation, and I know it can get a bit flummoxing in terms of the jargon, is that history tells you that if you buy at a low valuation and go 10 years down the line, so a decent amount of time down the line, buying at a low valuation stacks the odds in your favour of making a good real return a good way in the future. So say 10 years to your question. If you draw a line up from where the UK is now, so the UK is on about 13.5 times that price to earnings measure that I was talking about. Historically, and that's not to say things can't be different in the future, but historically that would suggest you go 10 years out, you should make a good real return. That again, that's not to say there won't be drawdowns in the interim. That's not to say that history won't be different this time. But that's why I'm positive on the UK. And there are individual stocks that I'm very excited about, but I don't want to give any stock tips, so I'll keep them to myself. Come and chat to me afterwards. But it's really the value of the whole market that excites me. And in contrast, as Nina rightly says, to some other markets out there.
What about particular sectors? Can we draw you on that one?
I maybe feel slightly differently about defence. I think that's, 5 years ago, the opposite would have been true in that, you'd mentioned that you own BAE Systems and you'd get a sort of sharp intake of breath and the attitude to that has changed, but also the value, again, coming back to valuation, the valuation has changed. So the areas where the valuation would be pointing you to at the moment would be the areas that people are most sceptical on. So things like the UK domestic economy, thinking about things like UK building materials companies that are at the forefront of the whims of the UK housing market, where there's been some possibly questionable government decisions, but it doesn't mean that we don't need to probably build more houses in the future. And these are areas that people are sceptical on. So as a sort of natural contrarian, I'm drawn to the things that people are most willing to write off, and those domestic UK smaller mid-cap type companies are that area that I'm being drawn to at the moment.
Okay, well, I think we can open the floor up to some questions. We've got 5 minutes remaining if anyone has anything to ask. Yeah.
Let's take a mic.
You don't need a mic.
Yeah. Go for it.
Shout.
So, artificial intelligence, how do you think is it going to affect investing? Or are there now, I don't really know, are there now tools that will, I don't know, help in terms of investment, or any feedback or input that you can give us in terms of artificial intelligence and investing?
Sure. I'm happy to have a quick chat. So there was a great article in the FT the other day that basically said, can AI replicate our job yet? No. As in, can it build a model? Can it make a sensible suggestion for the future? No. Coincidentally, I've actually got Bloomberg coming in tomorrow to teach me about all of the AI tools that Bloomberg now has. So I think it's early days, but I can now do things on my screening tools, Bloomberg, like show me everything in the UK market with this valuation, this yield, and it can update it for me. So something that would have taken me probably hours, I can now do in no time at all. So I think it's going to make if you think of investing as kind of a funnel of ideas to get to the ultimate decision at the bottom, I think it's going to make the funnel much quicker and easier, but ultimately it will need the person to do the work still, which is good. I have a job.
No, I feel exactly the same, and I think AI adoption is now happening quicker, but I think what it does is increases productivity as opposed to completely replace. And I think when it comes to investing, that advisor-client relationship you can't replace with AI. So I think that still remains key because it's a trust relationship, right? And I think people would be quite hesitant to trust AI off the bat. So I think that still remains.
Just one thing for me is if you think about investing in AI, there are some specialist AI funds. There's only a handful. There's 1 or 2 active funds I can think of, and there's a couple of index funds or ETFs that track a basket of stocks that could potentially be AI winners or they're already benefiting from AI. But what I'd say is that's a very high risk area. You're you're focusing your efforts there on one particular theme. Even if you went down one risk level and went to like a technology fund, you're going to get a lot of AI exposure anyway. And then if you go further down the risk spectrum and invest in like a global equities fund, you're still going to get AI because global fund managers will want exposure to AI, and it's quite often a key part of their portfolio.
Okay, thanks for taking over there.
I've recently seen this new, say, investment product called Pisces. Is that something worth looking into?
So this is where you can trade listed companies on the stock exchange, private companies on the stock exchange, right?
Yes.
To be honest, it's not my area, so I don't know a huge amount about it. But I'm ever so slightly confused by it as a suggestion, given that we have a stock market. So I don't quite, as in, normally the phase would be you have a private company, it lists, everything's very transparent, it trades on AIM, it trades on the main market. I don't quite see why we need this earlier stage of being able to trade private companies and why you wouldn't just list that company on the normal stock market. But maybe I've misunderstood.
I think there are some quite strict regulations around when and what can trade as well.
Yeah, I know that London's been pretty, say, poor for IPOs this year compared to New York, Hong Kong. So maybe they're just trying to incentivize more investment.
They're trying. They really are trying. So over there, yeah.
Question about other asset classes for retail investors, specifically gold. A lot of bullish content and reportage about gold as the role of gold in a diversified portfolio. Seems to have been on a tear for decades now. As a retail investor, I've never quite understood whether or not it should play a role in my portfolio, and also in the interest of safe space questions, I'm not even sure how I would, as a retail investor, buy gold. So could you possibly kind of enlighten me about that?
So in terms of accessing gold, I'd probably say the easiest way is through investing in gold companies that are listed. And that way you get exposure to the gold price.
They're mining companies?
Mining companies, correct, but pure play gold companies. In terms of gold as an asset class, it has done extremely well. It's usually looked at as almost a safe haven or a defensive or inflation hedge, which I think is why it's particularly over the last couple of years done so well because of this inflation and sticky inflation that we've seen. So an allocation to gold makes sense when times are quite uncertain, but I wouldn't advocate for a huge allocation towards the asset class.
So the jargon is exchange traded commodity funds, ETCs. So there are quite a few providers that offer exposure to gold. Some of them track the spot price. Some will invest in gold mining shares. And when gold's doing well, gold mining shares typically like turbocharge the returns. They generally do better than the spot price. That's what I've been told over the years anyway.
So I buy an ETC the same way I would buy an ETF or something like that?
Yeah,
There are ETFs available as well, aren't there?
Yeah, there are ETFs, but they're quite, because it's a commodity, a lot of them fall under exchange traded commodity. Okay. But yeah, they're very similar to an ETF. They follow the up and down movements of a particular index or commodity. And there are actively managed funds as well that will invest in gold mining companies. And in terms of gold, and also another potential route is that there's a small number of wealth preservation investment trusts, and they all tend to have a small amount of exposure to gold. And the sort of, I mean, obviously this is obviously not financial advice, but you often hear over the years that a small allocation to gold, that's typically 5 to 10%. But it depends on your risk appetite, your objectives, and your attitude to risk as well.
Okay, thank you. I think that's all we've got time for. We'll move on to the second panel. Thank you, everyone.
panellists are around at the end, so if anyone's got more questions and would like to quiz Nina or Laura or Kyle.
Going to stick around for drinks afterwards for a while, yeah. Okay, so this is the second panel of the evening, our Efficient Investing Tax Wrappers, Hidden Fees and More panel. With me, I've got the ShareSoc Non-Executive Director, Mark Northway, and Law Debenture COO, Trish Houston. Thank you, guys. So let's just start with a general overview of account types, what tax wrappers are, and what people should know about them. Mark, if you'd like to take that one. I know it's a broad topic, but you can distill it down into a few key bullet points.
Okay, so this is going to be fairly basic, which was the instruction, but I think you can. The idea is to provide a little bit of a framework as to how to think about these things, and broadly the pots into which you're going to end up investing come down to savings cash, come down to your house, come down to an ISA, which everyone will have heard of, come down to pensions, VCTs and EISs, and then property, private equity, and other. The tax enhanced wrappers are the ISA, the pension, the VCT, EIS. And for most people starting an investment journey, the more relevant ones are going to be that ISA and pension fund. So the primary was, I think one needs to sort of take a little bit of a step back. There's a flow of decision that starts from what is it that you're saving for, and is it for retirement? Is it to buy a house, put a deposit down on a house? Is it for school fees? Is it ultra long term? Is it to pass on to another generation? And that's going to be different for everybody, and that is going to drive a set of decisions, both as to how you allocate that cash, or those savings, into the different products, and then into which pots you're going to put it. So for most people, early on an investment journey, it's about pension versus ISA, and again, for most people, the clear decision is pension. And the reason for that is twofold. One, the government with a pension will effectively forego or postpone the taxation on the money that you're earning, and will do so for multiple years, 40 years in the case of somebody starting out. And the effect of that is almost like leverage, free leverage from the government. The government is handing you an extra X% of the money that you're saving and allowing you to put that into an investment product and earn the returns on that larger amount for multiple years. And we heard about the benefit of compounding. Effectively, they're turbocharging your compounding. The second real attraction for pensions is that most employers will sit alongside you and co-invest, provide a matched amount for the amount that you're putting into your pension up to a certain amount, and that's effectively free money. The return on that is infinite, and so those two reasons alone are pension. But you've got to think about liquidity, and liquidity is going to be, I think, a theme of the evening. Are you going to need that money at any time in the next 40 years? And if you are, then back away. And as you back away, the first point that you back into is an ISA, because an ISA gives you no tax benefit on the front end, but it allows you to earn to grow your investment portfolio in a tax-free environment, and to take out any original cash and any growth with no taxation at all. And so that's your second go-to. Sorry, that was a bit of a long response, but
I just want to clarify, when we talk about tax wrappers, we're talking about there is some tax benefit of using these vehicles. That is the clear overriding focus.
yes. So the government, and we're very, very lucky in the UK, the government will allow us to invest with benefits relative to, I mean, your baseline is, if I put money in a trading account and I invest it and I make profits, what happens? And the answer is generally you'll make those profits, you'll pay a tax on those earnings, and you'll have an amount left at the end of it. The the intention with the tax wrappers is to incentivize money to go into investments either at a faster rate for pace or earlier or into perhaps more risky areas. And so in the case of the pension, it's about relieving the strain on the UK government of providing pensions in old age. With ISAs, it's about stimulating savings generally. And with EIS and VCT, it's generally about the risk. It's about getting money into early stage, high risk investments. And the risk and liquidity elements are the decisions for the individual.
Yeah, it's the liquidity element as well. And perhaps you could talk about this a bit, Trish. Like when it comes to pensions, they are tax advantage.
Yep.
But if you take that money out too early, you lose that tax advantage. So if you could just speak a bit about that and how that needs to be considered in the overall concept of planning.
I can. My specialist area is not that. I think I was brought along to share some of the war wounds of some very bad investment decisions I've made.
That you can use that as
I
well.
can talk about some of that. So yes, with a pension, you do have to make sure that you are able to lock it away for a long time. Otherwise, you do pay some pretty hefty tax penalties as a result of that. But I've got a slightly different angle that I'll add on Mark's comments there about liquidity, because does everybody understand what we mean when we're talking about liquidity? So it's how much access you've got to actually turn those investments into cash.
With cash being the most liquid thing
Cash
possible.
being the most liquid, you can go down to the supermarket and buy something with it. Exactly. So I throughout my fairly modest investing career have actually benefited from making some mistakes about liquidity, which we talked about when we were having a chat about this last week, where I spent some time before university saving up my pennies, and I went and accidentally put it into a 5-year thing called a guaranteed equity bond, aged 18, which I don't think in a million years you'd let an 18-year-old buy now. But it turned out to be one of the best decisions I ever made, because all it meant was I couldn't touch a penny of it when I was at university. So I finished university and had a nice big cash payout and was able to go travelling. So I think if you listened to any of the experts, they would tell you to not do that. But sometimes it might pay off. So I've also heard that when your children are reaching ages where they might be able to get their hands on some of those government trust funds, if they have them, then that might be a good to remove liquidity from them on purpose. So liquidity can be useful actually to remove it if you're not to be trusted.
But that also speaks into planning around life objectives.
Yep.
It's not just about making the most of any tax wrapper
Yep.
because it's available.
Yep.
You've got to look at these things in terms of what you want to achieve and when you want to achieve
Exactly, and I think that's the really important bit, because some of the things that both, particularly Nina was talking about earlier, about if you want to engage a financial planner or someone to help you with this, that perhaps the AI can't do quite so well, is ask you the real questions and really understand what your objectives are, what your lifestyle is like, and when you're going to need that money, and that's really where the liquidity piece really comes in. There's another product you didn't touch on, Mark, but there's the LISA. That's another interesting one, which is the lifetime ISA, which you have to be below 40, I think, to invest in it. Is that right? To start it, to be below 40. And when you invest in that, you can only take the money out for buying your first home, or once you're in your 60s, I think. So again, that's another quite interesting wrapper, and you get a slightly accelerated tax back from the government on that. But again, you're really locking that away for quite a long time. So you'd want to make sure you are happy to do that.
Yeah, I was going to ask you, Mark, we were speaking earlier about, you were saying that pensions are one of the best tax wrappers you can look at. But for someone who's just starting their investment journey, say someone who's 18, 19, they may look at a pension and say, oh, I don't need to worry about that, or why should I be putting my money in there and I can't touch it for 20 years? How should they look at pensions versus ISAs versus other products in the concept of their lifetime goals at that age?
So I think the key thing is to be trying to get the tax benefit that the government is going to give you. So if a pension is not attractive for intellectual reasons, for lifestyle reasons, the ISA is an absolutely logical place to go, with one caveat, and I know I didn't mention ISAs, partly because I don't understand them, and partly because they're getting a bit of a bad rap at the moment. But the primary distinction in ISAs is cash versus stock, shares, and there's been a lot of focus from the government about the amount of savings that have gone into tax-advantaged cash ISAs and are sitting effectively useless. They are funding the economy through intermediaries. They're funding a lot of the savings banks and running through them into the economy. But from the saver's perspective, cash is generally an idle asset. It doesn't keep pace with inflation. It erodes over time, and so if you're going to save and you're going to save and you're going to invest, do it in the stock market. Unless your access to that cash is in the next 6 months, in which case, no, by all means, go cash. But if you've got a reasonable long-term perspective, go into the stock market, do it through a tax-enhanced investment, and that takes you straight into ISA territory. It's a very simple. But the advice has been mentioned. For anybody other than a trivial saver, the value of advice is not to be understated, and certainly if you're making lifetime choices, it's much better to be handheld, and that can be done through an advisor. It can be done through associations. ShareStock, our association, has learning groups. It has Signet is a sub-association of ours that does beginner and intermediate sessions for investors, mainly to meet each other and to discuss precisely these issues and come to a consensus as to what they should be doing. So there are lots of ways of doing it, but taking advice is key.
So that's something we're going to move on to, is when you're looking at investing and advice, there are a lot of options out there. There are robo-advisors, there's self-managed platforms, there are things like St. James's Place, Polaris funds and Vanguard's life strategy funds. How should people look at that? Considering everything else, what should they look to use? Maybe we can start with you on this one, Trish, if you've got any war wounds.
I'm going to give the not professional polished answer. So for me, I think a lot of it is about lifestyle as well and capacity. So if you want to really engage in investment markets, it's quite fun to go and have a little play on, you only have to buy a couple of shares in something to be able to sort of follow it and track it. But I certainly would suggest people don't do that with any meaningful amount of their capital. And a story that I've got on that was I was one of those people who bought the famous Ocado share, because I'd heard of Ocado and I thought this was very exciting. And I think it's James will let me know, it's down something like 86% over the last 5 years, but it's really fun, and it actually caused me, I spent about £50 and I enjoyed it, and it helped me to understand what shares are, helped me to engage it. So I think there are things like that where there is some argument to say you should go and do things on your own, but largely I would suggest, absolutely getting advice. But I think it does differ on the period of life that you're at, and also your own confidence. So, if you get to a stage where you don't have the time to do this, you're really going to be much better off getting someone who can really handhold you all the way through. Whereas if it's something that you have maybe got a bit of time, you maybe don't have the experience, but you've got the time, you then can potentially go and follow some of the sort of advice that you'd get from someone like StockShare, or you'd get from looking at any of the platforms will have some really interesting articles you can read. But in terms of any material portion of your portfolio, you want to make sure someone who knows what they're doing is helping you with that.
I mean, it comes down entirely to intellectual interest. If you want to pick stocks, it's a fantastic sport. It's generally not a very lucrative one, but for some people it is. If you want to track what a fund manager is doing in terms of active share, and maybe even co-invest along buy a share portfolio that effectively tracks that fund manager, again, from the intellectual perspective, that's fantastic. Identifying a fund manager, as was mentioned earlier, who provides consistent alpha being value added above what the benchmark is doing after costs, is quite difficult. It's very rare. We've got the advantage of sitting in Law Deb's office, and they are one of the few people who over a 5 and 20-year time frame have managed to do that. But it's much rarer than you would think. So at the other end of the spectrum is a sort of a relaxed approach where one's happy to let someone else take the strain and effectively to take the market return without trying to beat that market return, and that puts you into passive space. So I think it just depends on your own personal makeup and your own risk capacity, as you said.
And there's something you mentioned at the beginning of your previous answer. You were saying the value of advice is far more than you ever think. And a lot of people might balk at paying for advice, but it is worth it in the long term.
It comes down to size of portfolio largely. There is definitely a size of portfolio below which it's difficult to find advice that is priced at a level that makes sense. And at that point, it's self-learning. It's looking at online courses and so on and so forth. But at the point where there is any material amount being invested, the value of advice, not least in terms of how to invest, but also in terms of inheritance tax and the likes, it's super valuable.
And what about the fee piece? When we're looking at investments or different structures of investments, how should you view fees?
So I'll take a first stab. The answer is simply to look at the total cost of investing. There are multiple fees involved. They are difficult, even after the government has made huge changes to the rules. And in fact, investment trust is a classic case of where there's a continuing argument over fees. There's the underlying cost of holding the shares. There's the fund management cost on top of that. There's custody. There's advice sitting on top of that. Very often there's a wealth manager involved, and identifying the total stack of fees is very difficult, but it is critical. It's slightly unintuitive, but investing is one of the very few places where the more you pay, generally the less value that you get. There is a correlation between cost and performance, and that is why some of the passive funds have done as well as they've done. And that isn't to say that there are not fees that you can pay that will provide a return, but reassuringly expensive is not a good adage in the financial markets. Sorry.
I think all that I would add to that is I think we go back to the earlier point a bit about where you're at in your sort of life journey and how much time and energy you've got for things. So you might find that at a time where perhaps you're time poor, you want to actually pay a bit more for someone who's actually going to consolidate everything, give you nice reports, really hold your hand through everything. And perhaps when you're at a time you've got more ability to do it, you could choose cheaper options. But there was a comment that Kyle made at the beginning where he was talking about if you were going into a fund or something, really do have a look at how they're moving against, how they have historically moved against the benchmark, because that will give you a pretty clear indication about whether they're doing just the same thing as the benchmark is, or if they're actually doing something active. And to the point we've made, you shouldn't be paying for passiveness. You should be paying for activity. It's definitely worth looking at history to see that sort of difference.
So be very aware of what you're paying for is essentially the main lesson, and take that into account with everything else that you're looking at.
Yeah.
So, Mark, I want to ask you something. We've had a couple of comments earlier about VCTs and EIS, which seem, this is a bit more advanced, but I feel a lot of people get sucked into them because they think there are tax benefits. But these are quite risky vehicles, and it's a case of not going head over heels for the tax benefit without really understanding what you're getting into.
Yeah, so I'm a casualty here. Not so much VCTs are property enterprise trusts, but similar concepts. wherever there is a tax benefit for going into a very specific investment, there is the risk that the value of the asset before it's acquired by the vehicle that you're going into has already reflected that tax benefit. In other words, somebody else takes advantage of the tax benefit, and you end up with what is effectively an overpriced investment with a tax benefit, bringing it down to a correctly priced investment, but an ultra high risk investment in the case of particularly EIS. But also VCTs, the rules have changed over the last few years to increase the risk that's sitting in VCT portfolios. They're not for everybody. They are definitely a portion of your portfolio rather than your whole portfolio. They're to be approached with extreme caution and treated as high risk. So those caveats don't apply in the case of ISAs and pensions. There is nothing suggesting that a seller trying to sell into a pension fund can in any way benefit from the tax benefit in a pension fund. So it's a slightly sort of convoluted argument, but EIS and VCT to be handled with care.
I should just illustrate that VCT and EIS, they're both investment vehicles for investing in very small companies. And the risk that comes with that is much higher than the tax benefit involved.
And the tax benefit is specifically designed to push people into that risk. It's designed to bring capital to areas of the market that struggle for capital. One of the themes of the previous panel, which was very interesting, was value, and also small caps were mentioned. And those are what are referred to as risk factors that were studied very heavily for many years. And it is the case that historically, if you go into value stocks, you will tend to outperform the market. It is the case that if you go into small caps, you will tend to outperform the whole market. And the primary driver of that is the fact that capital doesn't want to go there. It's either under-researched, there are reputational risks for fund managers in getting there, and so these are areas that struggle to achieve capital, and therefore they have to overpay for capital.
Okay, we're going to run out of time in a minute, but I'd like to open the floor to some questions. If anyone has any questions on tax wrappers and fees and yes.
Where are SIPPs in all of this? They're self-investing pension funds or something like that? Where do they sit in the whole?
So I just put them under the bracket of pensions. So it's essentially a more flexible, more personalised wrapper within which you can choose a broader range of investments. And alongside that, there's also SAS, which is even more flexible and has started to get a very bad name because people put properties in there and so on and so forth. But they're all in that broader bracket of pension.
Why are they getting bad name for putting properties in there? What's the rationale for that?
There's a current administration of Hartley Pensions, which was a pensions administrator that bought up many SIPP and SAS providers who had very, very illiquid, very complicated portfolios, and that the closure of that firm relates to all sorts of complexities that were never anticipated in the first place. Essentially, SIPPs are still, I think, on the safe side. SAS is somewhat...
But can you put your property or a property investment into your SIPP?
That's a good question. I'm not sure that you can.
I
think it depends on the. I think it depends on the provider.
I don't think you can in Ireland.
Well, I don't come from the Isle of Man, but I've got family who have been and still are on the Isle of Man.
I'm sure you can do it in Republic of Ireland, but you can't do it in the UK.
You can do it with the Republic of Ireland, okay. Right. But the Isle of Man is its own little sphere, and they do a lot of insurance bonds, and you can put property into that. So you can't do that. You don't think you can put your own...
I think SAS was allowed SIPPs. I wasn't sure whether it was providers that were restricting, because there's a difference also between what you can do legally within a wrapper and what a provider will allow you to do. And so, but to all intents and purposes, you're in an area there where you will be taking very serious advice, including legal advice, and so it's a subtlety which won't affect most.
That will be very illiquid. Property within a pension.
And I'm sorry, I know I'm usurping this, but I want to go back on the liquidity side and say we talked about the liquidity of wrappers, but there's also the liquidity investments that you put inside those wrappers. And I think it's very important for investors to think about not only will the wrapper allow me to, but what are the liquidity characteristics of the piece of paper that I have bought. And you've got a whole spectrum there that starts from UCITS funds, which are highly liquid and very well protected, through non-UCITS retail schemes, through what is now the government's LTAFs, the long-term asset funds, then into private equity and so on and so forth. But on the way through that, you hit investment trusts. And the investment trusts are fantastic because they are a liquidity transformation mechanism that allows you to buy into almost any liquid or illiquid asset class whilst retaining the ability to sell on a day-to-day basis. So it's a very underappreciated area of the market, which to many people is the jewel in the crown.
Yeah, we got one more time for one more question. If anyone else, yeah.
Thanks. You mentioned that the VCT and EIS have their separate tax benefits. Would you ever consider doing a VCT or EIS within a SIPP? Are you allowed to, and would it be beneficial?
We're getting into specialists.
I mean, you can buy the shares of the VCT into a SIPP. Whether you can do that as a going into a new VCT with the tax benefit, I suspect not. I suspect that's a secondary transaction.
But the platform has allowed me to do it. Gave me the options. Do you want VCT within your SIPP?
Then you've answered your own question.
This is getting into the nitty gritty weeds. I say
we knew you were going to.
Please take advice.
He was in the lift.
Oh, really? I was going to say, if we go back to the early points, I think we are realising that some of our audience here need this financial planning advice that we've talked about. So this would be a great opportunity for you to take some advice rather than us.
I have a question online about financial incentives from different platforms. Carl, maybe this is for you, but someone said, should I take up financial incentives from different platforms to open accounts with them? And if so, how easy is it to transfer money between platforms? Will I lose out by doing it?
Well, it might roll the microphone. I think it's a really hard one to answer. You know, there are certain platforms that have sort of like offers or incentives, and you know, what you got to remember is that, you know, investing's a long-term game. You're investing, for the long term. You have a goal, so you've got to weigh up the long term. And you know, if you're attracted by the offer, then you've got to take your own view. Really, it's a really difficult one for me to give an opinion on.
Not exit fees.
Well, I mean, we don't have exit fees at Interactive Investor. Yeah, I think it's a case of looking under the bonnet. And in terms of transferring, it's a case by case example. But the industry has been getting better at making it quicker. So if you do change platforms, I mean, I've been in this industry for 15 years, and 15 years ago, it's not as quick as it is today. I'll tell you that for a fact.
As someone who just moved his SIPP, I can tell you it's much faster than it used to be. And the incentives do help, but I do think it's sensible to say it shouldn't just be you're moving because you want to make 200 quid. That's not a sensible decision.
I've actually also recently moved, and it was like, I wouldn't move just for that stuff, but I've just moved recently, and it was actually quite easy. A bit like the banks, how the banks have now been required by the government to make sure you can change bank accounts very easily. There's similar things, I think, going on in the investment industry.
Anyone else? Yep.
When you have a pension with a company, you're an employee of a company, can you also have a SIPP or no?
You can, yes. So there'll be limits on how much money you can put into pensions in total in a year. So you'd need to take both of those into consideration. But yes, if you've got space in your allowance, you can absolutely do that.
Mark, do you have any Anything to add on that?
No, nothing on that. There was just one other point that occurred to me earlier today that we haven't covered, which is that when you invest in a tax-enhanced wrapper, you generally can't borrow against it. It's something that catches people out. If you go to your bank and say, I've got 250,000 in an ISA and I'd like to borrow 100,000, they will say, no, you cannot use it as collateral.
That's going to be quite niche, though, that area. All right, okay, thank you, everyone. I think it's drinks time.
Yes. Thank you.